In November of the year 1923, a schoolteacher in Berlin received her monthly salary in the morning. By noon, it could no longer buy a loaf of bread. Prices were not rising by the week or by the day. They were rising by the minute. A chalkboard inside a bakery listed the price of bread in the hundreds of billions of marks. Customers queued with wheelbarrows of cash, not to buy in bulk, but to keep up. While they waited, the price was crossed out and rewritten, again and again. This was not war. This was not invasion. This was monetary collapse, and it did not stay in Germany. It appeared in Latin America. It returned in Eastern Europe. It re-emerged in the Middle East. It resurfaced in the early decades of the 21st century. Every time, the story followed the same arc. The currency failed first. Then access failed. Trust failed last. What most people misunderstand is this: money did not disappear. It moved from savers to debtors, from wages to assets, from those trapped inside the system to those positioned outside it. So the real question is not whether currencies fail. History already answered that. The real question is far more uncomfortable. When money stops working the way it used to, or what survives? And, just as important, who does not? To answer that, the analysis must step back from panic and look at structure, because collapse is never random. It is built long before it arrives. To understand why monetary systems fail in such predictable ways, we must first clarify what money is, how it is supposed to work, and what changes when trust quietly erodes. Money is not wealth. It is a coordination tool. Its primary function is not to make people rich, but to allow strangers to exchange labor, goods, and time without constant negotiation. For that system to function, money must reliably perform three roles. It must serve as a medium of exchange, a unit of account, and a store of value. When any one of these functions weakens, friction increases. When all three fail, the system breaks. Throughout history, money has taken many forms. Metal coins, paper notes, bank deposits, and digital balances all share one common trait. Their value depends not on physical substance, but on collective belief. Gold required trust in weight and purity. Paper required trust in the issuer. Modern money requires trust in institutions, policy frameworks, and the future behavior of the state. This is where monetary failure begins. Not with inflation charts, but with incentives. Modern fiat systems are built on an implicit contract. Citizens accept currency in exchange for labor and savings because they believe purchasing power will be reasonably preserved over time. Governments, in return, gain flexibility. They can tax, borrow, and spend in ways that smooth shocks and stabilize growth. As long as productivity rises and institutions remain credible, the contract holds. When that balance shifts, trust becomes fragile. Inflation is not merely rising prices. It is a signal that the coordination function of money is degrading. People stop planning in years and start planning in weeks. Long-term contracts lose meaning. Savings become speculative. The future is discounted aggressively. Hyperinflation represents the extreme end of this process, but collapse does not require it. Many systems fail quietly. Real wages stagnate while asset prices rise. Purchasing power erodes without headline panic. The currency technically survives, but its role as a store of value disappears. History shows that monetary breakdown rarely begins with malicious intent. It begins with short-term solutions to long-term problems: war financing, demographic pressure, external shocks, political gridlock. Each decision appears rational in isolation. Together, they accumulate risk. The Weimar Republic did not collapse because Germans suddenly lost discipline. It collapsed because fiscal obligations exceeded productive capacity, and monetary expansion became the path of least resistance. Zimbabwe did not implode because citizens rejected money. It imploded because output collapsed while spending continued. Lebanon did not fail because banks vanished. It failed because confidence in the system outpaced the ability to sustain it. In each case, the mechanism was different. The outcome was the same. Once trust erodes, behavior changes faster than policy. People shift from saving to spending, from local currency to foreign substitutes, from productive investment to asset protection. These shifts are not ideological, they are adaptive. And once adaptation becomes widespread, reversal becomes extremely difficult. Monetary systems are confidence structures. They can bend under pressure. But once cracked, they rarely heal smoothly. This context matters because collapse is often misunderstood as chaos. In reality, it follows logic, it unfolds in stages, and most importantly, it does not affect all participants equally. To see who survives and who does not, the analysis must now move beyond definitions and examine the forces that quietly push systems past the point of return. Monetary collapse rarely begins inside a central bank. It begins inside the budget. Fiscal dominance describes a condition in which government spending commitments quietly overpower monetary discipline. In this state, monetary policy no longer exists to preserve stability. It exists to keep the fiscal system alive. Interest rates, money supply, and liquidity are no longer tools of balance. They become tools of survival. At first, the shift is invisible. Governments run deficits for rational reasons. Recessions reduce tax revenue. Wars demand financing. Aging populations expand pension and healthcare obligations. Each justification appears temporary. Each extension feels manageable. Over time, temporary measures become structural. The incentive trap forms when reversing course becomes politically harder than continuing forward. Raising taxes risks backlash. Cutting spending threatens voters who depend on transfers. Default destroys credibility instantly. Inflation, by contrast, spreads pain slowly. It blurs responsibility. It does not announce itself as confiscation. For policymakers under pressure, it becomes the least dangerous option. This is the core of fiscal dominance. Monetary policy stops asking what is optimal for price stability and starts asking what is tolerable for debt service. History makes this pattern clear. In Weimar Germany, reparations and domestic obligations exceeded productive output. Tax capacity lagged behind spending promises. Rather than confront insolvency directly, the state monetized deficits. The printing press did not cause collapse by itself. It enabled the postponement of political decisions until trust finally broke. Zimbabwe followed a similar path decades later. Output collapsed after land seizures and capital flight. Revenue fell. Expenditures did not. The central bank filled the gap. Currency creation replaced production. Inflation followed not as an accident, but as an arithmetic outcome. The same mechanism operated more subtly in advanced economies. Persistent deficits financed by low interest rates encouraged governments to expand commitments without matching productivity growth. As long as borrowing costs remained suppressed, the system appeared stable. Debt grew. Balance sheets expanded. Risk accumulated quietly. Fiscal dominance also distorts incentives across the economy. When real interest rates fall below inflation, savers are punished and debtors are rewarded. Governments benefit. Asset owners benefit. Wage earners do not. Capital shifts from productive investment toward asset inflation. Growth becomes financial rather than real. This distortion is not neutral. It changes behavior. Households learn that saving in cash or deposits is futile. Firms learn that leverage is rewarded. Governments learn that delay is cheaper than reform. Over time, the economy becomes structurally dependent on continued monetary accommodation. Any attempt to normalize policy threatens collapse. This is why exits are so rare. Once fiscal dominance takes hold, reversing it requires either rapid growth, painful austerity, or explicit default. Each option carries political cost. Inflation carries political ambiguity. So inflation wins. Crucially, this process does not require hyperinflation. Long periods of moderate inflation combined with asset inflation achieve the same redistribution more quietly. Real debt burdens fall. Purchasing power erodes. Trust weakens gradually. The system survives, but only by shifting risk downward. By the time the public recognizes what has happened, the incentive structure is locked in. Monetary policy is trapped by fiscal reality. Stability depends on continued distortion. Reform becomes synonymous with crisis. This is the first force pushing monetary systems toward failure. Not ideology, not incompetence, incentives. But fiscal dominance alone does not produce collapse. It creates vulnerability. Collapse accelerates when that vulnerability collides with forces beyond domestic control. Those forces are external. Fiscal dominance weakens a system from within. Dangerous dependency is what pushes it over the edge. No modern economy is self-contained. Energy, food, medicine, technology, and industrial inputs flow across borders every day. As long as a country earns enough foreign currency to pay for what it cannot produce, these dependencies remain manageable. When that ability erodes, monetary stress turns into systemic crisis. This is where external constraints begin to matter. In Weimar Germany, the constraint was explicit. Reparations were denominated in foreign currency and gold. Domestic production had been damaged by war, yet external obligations remained fixed. Printing marks could pay local wages, but it could not generate dollars or gold. Each additional unit of domestic currency widened the gap between internal liquidity and external solvency. A century later, the same logic appeared in Venezuela. For years, oil exports funded imports and social spending. When oil prices fell and production collapsed, foreign currency earnings evaporated. Food, medicine, and industrial goods still had to be imported. The state printed bolivars to fill the fiscal gap, but bolivars could not buy dollars abroad. Shelves emptied, shortages spread, inflation accelerated. Lebanon's vulnerability took a different form. The economy depended on continuous inflows of foreign capital to sustain its currency peg and banking system. These inflows financed imports, public salaries, and debt service. When confidence cracked and capital stopped arriving, the peg collapsed. The currency failed, not because money was printed excessively at first, but because foreign exchange disappeared. Energy dependency amplifies this mechanism. When a country relies heavily on imported fuel, currency depreciation instantly raises production costs across the economy. Prices rise not only because of monetary expansion, but because real inputs become more expensive overnight. Inflation becomes structural rather than cyclical. Once external constraints bind, policy options narrow rapidly. Interest rate hikes deepen recession. Capital controls trap savings. Subsidies balloon. Governments ration access to foreign currency, favoring politically connected sectors. Official exchange rates diverge from reality. Parallel markets emerge. The economy fractures. At this stage, collapse enters daily life. Medicines vanish. Fuel queues form. Businesses shut down not because demand disappears, but because inputs cannot be sourced. Trust shifts from institutions to networks, yet collapse is not evenly distributed. Those with access to foreign currency, export revenues, or external connections adapt. Those without remain trapped inside the failing system. This is why dependency often matters more than debt levels alone. A country with high debt but strong export capacity can stabilize. A country with modest debt but severe import dependence can implode rapidly. External constraints do not create collapse by themselves. They accelerate it. They strip away the illusion that domestic money can substitute for global credibility. But even dependency does not fully explain who survives and who is wiped out. To understand that division, the analysis must move beyond governments and into the structure of assets and savings. Because once external pressure intensifies, states respond not only with policy, but with control. When fiscal pressure collides with external constraint, governments turn to a third mechanism. It is quieter than inflation and less visible than default, but often more destructive over time. This mechanism is financial repression. Financial repression refers to policies designed to keep capital inside the system and redirect it toward state survival. These policies rarely arrive all at once. They appear gradually: withdrawal limits, transfer delays, preferential exchange rates, forced conversions, regulated interest rates that sit well below inflation. Each measure is framed as temporary. Together, they rewire how wealth can move. At this stage, money does not vanish. It becomes trapped. The sequence is remarkably consistent across crises. First, access slows. Banks introduce daily limits. International transfers require approval. Then comes segmentation. Official exchange rates coexist with parallel markets. What is legal diverges from what is real. Finally, assets are redefined by decree. Deposits are converted. Contracts are rewritten. Losses are socialized without being named. Lebanon offers a clear example. Depositors could see their balances on screens, but could not move them. Dollar deposits inside the banking system were transformed into local currency equivalents at artificial rates. The loss was not declared as default. It was absorbed slowly, unevenly, and largely without recourse. Argentina has repeated this pattern across decades. During moments of stress, access to savings was restricted, foreign currency accounts were converted, and legal battles dragged on for years. By the time compensation arrived, real value had already disappeared. Financial repression works because it exploits asset immobility. Savings held in domestic banks are easy to control. Pension funds invested in government bonds are easy to direct. Real estate is visible, taxable, and jurisdiction-bound. These assets form what can be called the trapped layer of wealth. By contrast, assets with portability, external settlement, or foreign revenue streams occupy a different layer. Exporting firms receive foreign currency directly. Precious metals can be held outside the banking system. International equities settle beyond domestic controls. These assets are harder to repress without triggering immediate flight. This distinction explains a paradox that confuses many observers. During periods of high inflation, stock markets can rise sharply in nominal terms even as living standards collapse. Equity represents claims on real assets that reprice with currency depreciation, but not all equities behave the same. Firms earning revenue only in local currency see real margins collapse. Firms with export exposure or foreign revenues often gain real advantage. Financial repression, therefore, does not punish wealth equally. It penalizes form, not size. Two households with identical net worth can experience radically different outcomes depending on how that wealth is structured. Governments rely on this asymmetry. Repression reduces real debt burdens without triggering formal default. It preserves the appearance of solvency while shifting losses onto those least able to escape. The system survives by sacrificing credibility. Once repression takes hold, behavior changes. Savers stop trusting institutions. Firms stop investing for growth and start investing for protection. Capital seeks exits. Innovation slows. Trust erodes further. At this point, collapse is no longer a purely monetary event. It becomes a social one. But repression still does not complete the picture, because beyond trapped assets lies a deeper transformation, one that determines not just who survives, but who emerges stronger after the system resets. That transformation is redistribution. By the time inflation, dependency, and repression converge, monetary collapse stops being a technical failure. It becomes a redistribution mechanism. This is the most uncomfortable truth in the history of currency crises. Collapse does not simply destroy wealth, it reallocates it. And it does so along predictable lines. Inflation erodes liabilities faster than assets. Debtors benefit, creditors lose. Governments with large nominal debts see their real obligations shrink. Households holding savings in domestic currency watch purchasing power dissolve. The transfer is not debated in Parliament. It happens automatically, embedded in the mechanics of money. This is why states tolerate inflation longer than textbooks recommend. Default is explicit. It creates clear losers who can organize and resist. Inflation is ambiguous. It spreads losses across time. It blurs responsibility. By the time anger crystallizes, the transfer has already occurred. History leaves little doubt. During the Weimar collapse, industrialists with access to foreign currency and physical assets acquired factories, land, and companies at fractions of their former real value. Middle-class savers paid in marks and holding insurance policies or bonds were wiped out. The economy did not vanish. Ownership changed hands. The same pattern repeated across Latin America in the late 20th century. Hyperinflation erased domestic savings. Firms with dollar revenues consolidated market share. Political insiders with access to credit and foreign exchange emerged stronger after stabilization than before it. In Lebanon, those who moved capital early preserved value. Those who trusted the banking system absorbed losses through withdrawal limits and forced conversions. In Venezuela, businesses connected to import licenses and currency access survived while formal private industry collapsed. This redistribution is not random. It consistently favors four groups: those with debt denominated in collapsing currency, those holding assets tied to real production, those with access to foreign currency or external markets, and those with political proximity to decision-making. Everyone else is compressed. The middle class is hit hardest because its wealth sits inside the trapped layer: salaries, pensions, savings accounts, domestic real estate. These assets are large enough to matter, but immobile enough to control. Collapse turns them into shock absorbers for the system. Here lies the moral shock. The people who followed the rules suffer the most. Those who saved patiently, trusted institutions, and avoided risk are punished more severely than those who borrowed aggressively or exited early. Collapse does not reward prudence, it rewards position. This is why monetary crises leave scars that outlast stabilization. People do not just lose money, they lose belief. When discipline is punished and proximity is rewarded, trust collapses faster than currency. Redistribution through collapse also reshapes politics. Extremes gain ground, institutions lose legitimacy, emigration accelerates, societies hollow out as those with mobility leave first. And yet, from the perspective of system survival, the mechanism works. Debts are reduced, ownership consolidates, a new equilibrium emerges, often with fewer players and greater concentration of power. Collapse, then, is not the end of an economy. It is a reset of its ownership structure. Understanding this reframes the survival question. It is no longer enough to ask which assets hedge inflation. The real question is which assets remain outside the reach of repression, dependency, and forced transfer. To answer that, the analysis must now widen beyond individual countries and compare how different systems absorb or deflect collapse pressures. Monetary collapse does not unfold evenly across countries. The mechanics repeat, but outcomes diverge sharply depending on institutions, external credibility, and structural resilience. Comparison reveals why some systems bend while others fracture. Consider the divergence between the United States and Europe since the global financial crisis. Over the same period, the American economy expanded through technology, capital markets, and energy production, while much of Europe stagnated under fragmented fiscal authority, demographic decline, and energy dependence. The gap widened not because shocks were different, but because buffers were. Systems with deep capital markets and a single reserve currency absorbed stress through inflation, asset repricing, and fiscal expansion. Adjustment occurred quietly. Systems without those buffers relied on repression and redistribution. The United Kingdom illustrates a subtler version of this divide. Headline figures suggest resilience, yet much of that performance concentrates in London and the Southeast. When financial hubs are removed, productivity and income trends weaken significantly. Financial concentration masked structural fragility. Growth survived, but it did not spread. Emerging markets demonstrate the opposite dynamic. Countries with export capacity in commodities or manufacturing stabilized faster than those reliant on capital inflows. Nations able to earn foreign currency through energy, food, or industrial exports retained policy flexibility. Those dependent on tourism, remittances, or speculative finance did not. When confidence broke, foreign exchange evaporated and adjustment became abrupt. China represents a distinct model. Control over capital accounts, state banking, and strategic supply chains insulated the system from sudden collapse. Stability was preserved through control rather than openness. The trade-off was slower adjustment, constrained household wealth mobility, and rising internal imbalances. Collapse was delayed, not eliminated. Across these cases, a pattern emerges. Systems with diversified exports, credible institutions, and liquid markets distribute stress broadly and gradually. Systems lacking these features compress losses inward and downward. The middle class absorbs the shock. Mobility becomes the dividing line. The social consequences are profound. When savings evaporate and opportunity contracts, emigration accelerates. Human capital leaves first. Innovation slows. Political polarization intensifies. Trust in institutions erodes. These outcomes feed back into the system. As productive citizens exit, tax bases shrink. As trust collapses, compliance weakens. Governments respond with tighter controls, further discouraging investment. The spiral tightens. International comparison also explains why reserve currencies fail differently. They are not immune to stress, but they benefit from inertia. Global demand for settlement, trade, and reserves creates time. Adjustment occurs through inflation, fiscal expansion, and asset markets rather than sudden collapse. Pressure builds slowly. The timeline stretches. This is why debt levels alone mislead. What matters is not how much a country owes, but whether it controls critical inputs. It earns foreign currency and maintains institutional credibility. Without these, even modest shocks can trigger systemic failure. The comparison leads to a practical conclusion. Collapse is uneven. Survival depends less on prediction than on structure. If outcomes diverge across systems, the next question becomes unavoidable. What can be done before pressure peaks? And what choices actually preserve optionality? There is no permanent fix for monetary systems. History offers no such promise. What it does offer are clear distinctions between systems that adapt under pressure and those that fracture when stress accumulates. The difference is not prediction, it is preparation. At the national level, the first constraint is fiscal credibility. Governments that align long-term spending commitments with realistic revenue capacity preserve room to maneuver. This does not require constant austerity. It requires transparency about trade-offs. When obligations grow faster than productivity, collapse is delayed through inflation rather than avoided. Adjustment postponed becomes adjustment multiplied. The second constraint is external resilience. Economies that earn foreign currency retain optionality. Energy security, food production, and industrial capacity are not ideological preferences. They are shock absorbers. Countries that outsource critical inputs during stable periods discover the cost of dependency during crises. Diversification is slower and more expensive than specialization, but it preserves sovereignty when conditions tighten. The third constraint is institutional trust. Independent central banks, predictable legal systems, and credible regulation do not eliminate risk. They slow panic when mistakes occur. Trust keeps capital mobile inside the system long enough for adjustment to take place. Once trust breaks, even technically sound policy struggles to restore confidence. At the household and firm level, the logic mirrors the macro structure. Survival depends less on forecasting collapse than on reducing single points of failure. Income, savings, and assets concentrated in one currency, one jurisdiction, and one financial system create fragility. Optionality comes from diversification across forms and locations, assets with portability, external settlement, or foreign revenue exposure consistently outperform trapped assets during stress. This does not require abandoning domestic investment or productive activity. It requires understanding which assets remain accessible when controls tighten. The goal is not escape, it is flexibility. Looking forward, three broad scenarios emerge. In the first, reform arrives early. Fiscal adjustments occur gradually. Supply dependencies are reduced. Growth resumes unevenly but sustainably. Inflation recedes without repression. This path is rare but possible. In the second, adjustment is delayed. Inflation persists. Asset prices rise unevenly. Financial repression expands quietly. Living standards erode slowly. Emigration accelerates. The system survives, but confidence does not fully recover. This is the most common outcome. In the third, confidence breaks abruptly. Capital controls intensify. Parallel markets dominate. Redistribution accelerates. Stabilization eventually occurs, but only after deep social damage and ownership consolidation. Collapse becomes reset. Which path prevails depends less on ideology than on incentives. Systems reform when pressure aligns with political survival. They collapse when delay remains cheaper than correction. No society chooses collapse deliberately. It drifts toward it when the cost of reform appears higher than the cost of inflation. By the time that calculation reverses, options have narrowed. This leads to the final insight. Monetary collapse is not fate. It is the cumulative outcome of choices made under pressure, reinforced by incentives, and revealed through stress. Understanding those incentives is the first step toward changing outcomes. Monetary collapse is often described as an accident, a rare convergence of bad luck and poor leadership. History suggests something far less dramatic and far more unsettling. Collapse follows structure. It emerges where incentives reward delay, where dependency narrows options, and where control replaces reform. Across Weimar Germany, Latin America, Lebanon, and Venezuela, the pattern repeats. Currency fails first as a store of value. Access fails next. Trust fails last. By the time collapse becomes visible to the public, ownership has already shifted. The economy has not disappeared. It has been reorganized. The deepest damage is not financial alone. It is psychological. When savings vanish while insiders adapt, belief erodes. People stop trusting that discipline leads to security. Societies hollow out. Talent leaves. Extremes rise. Collapse leaves scars long after stabilization. Yet the lesson is not despair. It is clarity. Monetary systems do not collapse overnight. They weaken quietly. Warnings appear early, embedded in incentives and behavior. Those who recognize patterns gain options. Those who do not become part of the adjustment. This is why survival is not about panic or prediction. It is about structure. Diversification across assets, income sources, and jurisdictions is not speculation. It is resilience. Understanding how systems transfer risk is the first defense against absorbing it. And here lies the uncomfortable truth. The system does not reward virtue. It rewards position. That does not mean withdrawal from society. It means awareness. It means refusing to confuse nominal stability with real security. It means preparing before rules change rather than reacting after they do. History does not demand fear. It demands attention. The pattern is visible. What happens next depends on who is willing to see it.